Let's ensure every dollar is in the drawer where it could do the most good. Do you have money in a taxable brokerage account, but feel like you don't have enough cash to make an IRA contribution this year? What you can do is sell some of your portfolio in the taxable account, pay a little bit of tax, move the cash to your bank account, and then use that to fund your IRA this year. There's a little tip for you. I'm Allie Jane Ayers, and this is Money Changes Everything. The Financial Home Edit Part 2, Organize and Strategize, the Drawer System. Welcome to Part 2 of this 3-part series inspired by Marie Kondo's The Life-Changing Magic of Tidying Up to help you get your shit together before the end of the year. Last week, we decluttered. Now, we have to find a place for what we kept. Key takeaways. Getting your finances organized now will save you stress and panic when tax season comes in April. There are plenty of December 31st deadlines when it comes to taxes, so getting your affairs in order now could mean avoiding a penalty in the future. Making the most of your capital gains and losses could help you get a smaller tax bill when April comes around. Decluttering is the fun part. You get to toss junk out and feel lighter. But once the pile is gone, you have to decide where everything actually belongs. Marie Kondo, in The Life-Changing Magic of Tidying Up, tells us that decluttering is step 1. But now we have to organize our beautiful things that we want to keep. We might reward ourselves with a trip to the Container Store for some sexy lucite shelving. Every sock and every dollar needs a proper drawer. As we approach the end of the year, this is the time when sorting and organizing your finances matters most. The IRS is not a spark joy kind of institution. Most of the IRS deadlines are December 31st, and if you miss them, you don't get a do-over in April. So let's get our IRAs put in the right drawers now. Retirement plans. Let's start with the retirement drawer. If you've got old 401ks floating around, this is the time to roll them over into one place. This is not glamorous work. It is, in fact, a somewhat painful process. I typically recommend that our clients pour themselves a drink before starting a 401k rollover because it really is terrible. So, it takes at least 60 days to roll over your money, and some companies will literally mail you a paper check that looks like a scam. So trust me, you do not want to wait until December 20th to start this process. Pick up the phone, endure the bad hold music, and get those accounts consolidated into an IRA or rolled into a 401k at your current employer. I promise you, it is worth the hassle. When everything's in one place, you'll have less paperwork, lower fees, and fewer accounts to lose track of. Once your rollovers are in motion, check whether you can still max out your retirement contributions for the year. For 401ks at your employer, you've got until December 31st to max those out. For IRAs and Roth IRAs, you have until April 15th. But finding the cash to make contributions to those retirement accounts and planning ahead now makes it much easier. Charitable gifting. Charitable gifting is another December 31st deadline. If you want that tax deduction, your donation has to clear the bank before the ball drops. On New Year's Eve, obviously. This is also the moment to think strategically. If you're not quite sure where you want to donate your money, but you're certain of a dollar amount, a donor-advised fund could be a suitable option. My condo metaphor actually works quite nicely here. Think of a donor-advised fund, we call them DAFs, as a drawer you open that you contribute money to, and then you can decide at a later date which charity you want to receive the cash. This investment account lets you bunch several years' worth of donations into one tax year while doling out the money to charities over time. They're relatively easy to set up, but could take a few weeks to get your bank linked up. And keep in mind that your contributions to a charity or donor advised fund must be made by December 31st to get the deduction this year. Capital gains. If you have taxable investments, look at your capital gains and losses before the year closes. Harvesting losses, meaning selling investments that have lost money this year and potentially buying something similar so you don't actually change the makeup of your portfolio, more on that in a future episode, is a great idea to lower your tax bill. But you have to act before December 31st. Again, the IRS doesn't care about anything you do in January. For those of you who buy and sell crypto, taking a look at that part of your portfolio is wise to see what gains or losses you're on the hook for this year. Let's ensure every dollar is in the drawer where it will do the most good. Do you have money in your taxable brokerage account that you could move to an IRA to make a contribution this year? That's what I do each November. I sell a little bit of my taxable portfolio and move it over to my Roth IRA, moving money from a taxable account to a tax-deferred one. And while you're at it, here are some other end-of-year organizing and sorting that most people miss. your solo 401k, and your SEP IRA. If you're self-employed, a solo 401k must be set up by December 31st if you want to contribute for the year. A SEP IRA can wait until your tax filing deadline. That timing difference matters if you're late to the party. Roth conversions. Proceed with caution here. You can convert pre-tax IRA money into a Roth IRA. You pay the tax now in exchange for tax-free growth later. This is really great if you happen to have a year where maybe you're not making as much money as you did last year. Maybe you're taking a year off. Maybe you're about to get married next year. So Roth conversions are a great topic for you and your financial advisor, or for you to handle on your own if you love reading the stuff that I publish. This move has to be done by December 31st, and the trick is to fill up your current tax bracket without spilling into the next. Again, low income year, great time for Roth conversions. Speaking of Roth, we've got backdoor Roth IRAs. High earners contribute to non-deductible IRAs and then convert it to a Roth. This is what we do for almost all of our clients every November. The catch here, we actually call it backdoor Rothapalooza. The catch here is the pro rata rule. If you have other pre-tax IRA money sitting around on December 31st, like a SEP IRA, the IRS makes you count all of it, not just the piece you want to convert. A workaround for this is to roll your pre-tax IRA money into a 401k before year end. We're getting a little bit in the weeds here, but that's why I typically prefer a solo 401k for high earning business owners, because that way we can do both a backdoor Roth IRA and a solo 401k, whereas we could not do a backdoor Roth IRA if we have a SEP IRA. You with me so far? Okay, good. Capital loss harvesting. Selling investments at a loss can offset gains and reduce taxable income. Just avoid the wash sale rule, which disallows the deduction if you buy the same substantially identical investment within 30 days. So basically, you just can't sell off your, I was going to say Google, but Google hasn't had a loss. You can't sell off your Blue Apron stock today and then buy it back tomorrow. You'd have to wait 30 days to buy that stock back. Capital gain harvesting. If your income is below $40,000, you might qualify for the zero capital gains tax bracket. That means you can sell investments, realize gains, and potentially pay zero tax. If you're getting married this year and your spouse has no or low income, this is a really interesting tax hack to explore with your accountant. Charitable giving with appreciated assets. Instead of donating cash, give stocks or funds that have grown in value. When you do this, you avoid paying capital gains tax and still get the deduction. Giving through a donor advised fund makes this even easier. Required minimum distributions. Once you hit a certain ripe age of 73 for most people, you're forced to take money out of retirement accounts. Miss it, and the penalty is brutal. 25% of what you should have withdrawn. Please ensure you complete this task by December 31st so you don't pay those penalties. 529 contributions. Some states give tax deductions or credits for contributions to this college savings account. But remember, you have to make the contribution by December 31st. Even small amounts can reduce your state tax bill. Once we've moved money around, let's do what Condo does best, the magical art of tidying up. Tidy up your paperwork. Update beneficiaries on retirement accounts and insurance, clean up old email preferences with your banks and brokerage firms, and make sure the important notices can actually reach you. We are trying to avoid the panic that comes with tax season and give ourselves a calmer way to start the year. Every dollar in the right drawer means one less thing to stress about later. I still fold my freaking underwear thanks to Marie Kondo. And here's my parting shot. The IRS doesn't care about your good intentions. Move your money before December 31st or it won't count for this year.